All right, welcome back everyone to another episode of the Nadlan Forum Podcast Daily. I'm Ruby, and with me as always is the one and only Lior. Today we're diving into this slippery fish called cash-out refinancing. But seriously, why do mortgage terms always sound like a secret society code? Honestly, the first time I heard cash-out refi, I legit thought it was a reality show game. And don't get me started on LTV. I was sure it was a new dating app for mortgage nerds. Looking for a loan-to-value partner, age 25 to 55?
I love that. In the US, every time someone throws out acronyms, it almost feels like you're back in the army or something. Except this is about your house instead of a tank. But yeah, let's break it down. Cash-out refinancing is, in simple words, when you replace your existing mortgage with a new, bigger one and get the difference in cash right now. So, if your home's worth $400K and you still owe $200K, your equity is that other $200K just quietly sitting there.
Right. And if you decide to do a cash-out refi, maybe you take out a new mortgage for, let's say, $300K. You pay off the old $200K and walk away with $100K in cash, minus closing costs, obviously, because apparently there's no escape from those pesky fees.
And it works almost exactly like getting your first mortgage. You gotta have good credit, steady income, and big one, the value of your home matters a lot. Most lenders, they'll cap what you can borrow at 80% of your home value. Sometimes a little more, depending on the lender and the market.
And the cool bit here is you don't juggle two loans like with a home equity loan, just one monthly payment. I mean, that's way less logistics. But my favorite thing, the interest rate you get is usually miles better than a credit card or a personal loan. We're talking 3 to 5% lower sometimes.
Yeah, actually, for most people, the difference is pretty huge. And depending on how you use the cash, like for home improvements, you could even get some tax perks. Although, after the 2017 tax changes, you really got to check with your CPA on what you can actually deduct.
The first time I looked at all those numbers and forms, I thought, nah, I'll just keep the kitchen ugly. But jokes aside, there's a real simplicity to consolidating all your stuff into one payment. Lot less stress when you know what comes out of your account every month.
That's big. But yeah, worth reminding, your house is the collateral. You miss payments and you're at risk. So that low rate comes with some big stakes. Just need to be realistic about it. Don't go wild just because there's cash on offer.
So once you've got your hands on that juicy equity, what do you do with it? Top of the list for Aussies, and honestly everyone, is renos, kitchens, bathrooms, that kind of thing. Not just for Instagram glory, but because the right upgrades often feed straight back into property value. Lior, you've seen this in practice, yeah?
Oh, absolutely. In Brooklyn, for example, a friend of mine used cash-out refinancing to totally redo his kitchen. We're talking full gut, like down to the studs. The thing is, the new mortgage wasn't much higher than his old one, but the value of his brownstone really jumped. And important, the kitchen wasn't just flash. It made the house a lot more livable.
Love a kitchen redo. And look, renovations are just one angle. Another smart move is paying off high-interest credit cards. Like, there was this one homeowner consolidated about $42,000 in card debt, chopped their monthly bills by $650. That's a free trip to Bali every month. Well, almost, once you take out New York rent.
Yeah, and the math checks out. If you're rolling 18-24% interest on credit cards and you swap that out for, say, a 6% mortgage rate, it's kind of a no-brainer, but you have to be disciplined. The risk is if you start running up more credit card debt, you just loop back into trouble.
For sure, don't use your home equity to buy a bunch of, inflatable flamingos off the internet. Big expenses like education, sometimes medical bills, maybe even investing in another property are smarter bets. The question I always ask is this move actually helping your finances long term? If not, maybe time for a rethink.
Totally. I've even seen folks use it to start a business. The rates beat most business loans. But again, not every use makes sense. Sometimes the safest play is to just lower your monthly costs and breathe a little easier. Especially with the way the market's been lately, like we discussed in last month's episode about rates holding steady. Gives everyone a bit of breathing room, you know?
Yeah, 100%. And knowing that certain renos can recoup 70-80% of what you spend when you sell, it's almost like you're investing in future Ruby or Rachel or whoever's listening. But yeah, don't treat your home equity like an ATM. Respect the future you.
All right, so if you're sold on the idea and want to tap your equity, the next question is, who do you actually borrow from? There's a buffet of choices now, way more than just big name banks. You've got traditional banks, credit unions, online lenders, brokers, and even private lenders. Each one's got its own flavor, so to speak.
For real, like if you want that classic sit with a human at the branch vibe, you'll probably feel happy with a traditional bank, Wells Fargo, BofA, the usual suspects. Solid, predictable, sometimes better if you're already a customer there. But if you're after more of a local, community feel, credit unions can be gold. Lower rates sometimes, more personalized service. They're not for profit, so their deals can be better.
And if you're techie and want to get approved in your pajamas, online lenders like Rocket Mortgage or Quicken can be hard to beat. The process is fast. Sometimes you can close in like a couple weeks, although you gotta be a bit careful because you miss the hand-holding that comes with physical branches.
Then there's mortgage brokers. They're like mortgage matchmakers, right? They know all the products, shop you around, and sometimes find deals you wouldn't sniff out yourself. But you want to make sure they're really working for you, not just steering you to whoever gives them the biggest commission.
Private lenders are the wild cards, flexible, sometimes willing to tackle complicated cases or offer custom terms. Could be smaller firms, even individual investors. Maybe not the best rates, but they fill gaps when the banks say no. In 2025, we've seen so many options. There's really a lender for every scenario now. And for me, what stands out about Nadlan Capital Group is just how much time they take to understand each client. They're super transparent and their rates are super competitive. I might be biased, but for a lot of people, they're the ones to beat this year.
And when you're choosing a lender, don't be shy to interrogate them a bit. What's the rate? What's the fine print? Are there prepayment penalties hiding in the shadows? How fast can they close? And hey, always check reviews, ask around, talk to a pro if you need to. This is your home. Don't let anyone rush your decision.
Exactly, Ruby. And just remember, the best lender isn't always the biggest. Look for custom service and transparency, like the stuff we've talked about all season. And talk to your financial advisor to make sure you're not getting in over your head.
All right, so that's a wrap on unlocking your home's equity and hopefully on deciphering a little more of the mortgage mystery. Next episode, we'll be tackling even more practical tips from the real world of property and lending. Lior, always a pleasure having your war stories here. Will you be back for the next? Or are you headed on a cash-out funded world tour?
I'm sticking around, Ruby. World Tour can wait. Thanks everyone for listening. Don't forget to check previous episodes if you want to dig deeper, and see you all next time.
Catch you soon, everyone. Take care and happy house hacking.